Welcome back to the deep dive. It is Saturday, January 17th, 2026.
Right.
And look, if you have glanced at your portfolio this morning, specifically if you hold any tech stocks, you might be feeling a little bit of that January chill.
Oh, yeah.
The markets are, well, let's call them anxious.
Anxious is putting it politely. I'd say it's been a volatile start to the year, to say the least.
Yeah.
The sentiment out there it's fragile.
Exactly. But that is exactly why we're here today. We aren't here to panic. We're here to hunt. We're looking at a company that is currently trading near its 52-week lows, sitting right around, what, $25.91.
Right around there.
And if you just look at the chart on your phone, it looks like a disaster.
Oh, on the surface, sure, it looks completely beaten down.
It looks like a falling knife you absolutely do not want to catch. But the deep dive mission isn't to look at the surface.
No, of course not.
Right. The sources we have for today, specifically an exhaustive, brand new research report from StockAnalytics.AI.
Requested by one of our members, right?
Yeah, requested by one of our members. It suggests that this isn't a disaster, it's a dislocation.
It's the classic value investing setup.
Yeah.
We are looking at a situation where macro fear has pushed the price significantly below the actual value of the enterprise.
And just to tease where we're going with this right off the bat, because I know everyone is wondering buy or sell. Our analysis suggests this is basically a dollar bill selling for 70 cents.
I mean, that's the bottom line.
By the end of this deep dive, we are going to walk through a calculation that puts the intrinsic value of this stock closer to $37 a share.
Which is a massive upside from where it's sitting today. We're talking about a potential, 40% gap between price and value?
Huge. But to get there, we have to wade through some murky waters. We have to talk about the intent economy. We have to discuss the impact of the 2025 tariffs.
Which I know is on everyone's mind.
And the massive turnaround led by Bill Reddy.
It is going to be a fascinating dissection of a company that I think is largely misunderstood by the broader market.
So buckle up. We are going to apply a Buffett-style value lens to a modern tech company. You might be seeing red in your portfolio due to the 2025 tariffs, but we're looking for the dislocation, where fear has pushed the price below the value.
Chapters 1 to 3, Business, Management, and Financials.
Business understanding.
So let's start with the basics. When most people hear Pinterest, they immediately think social media.
Oh, absolutely.
They lump it in with the basket. It's in the ETF with Meta, with Snap, with whatever TikTok is doing this week.
Right. And our main source today argues that this is basically a fatal error in analysis.
The fatal error.
It is a category error, plain and simple. If you are valuing Pinterest as a social media company, you are looking at the wrong metrics, you are comparing it to the wrong peers, and you are misunderstanding the fundamental utility of the product.
Okay, let's unpack this.
Yeah.
Because I think for the average person, it feels like social media. You scroll, you see pictures, you like things. What is the fundamental difference that investors are missing?
It really comes down to two words: intent versus attention.
Intent versus attention.
Think about why you open TikTok or Instagram. You're there to be entertained. You're there to kill time. You're standing in line at the coffee shop.
It's passive consumption.
It is entirely passive, and it's often backward-looking.
Right. It's look at this meal I ate, or look at this party I went to.
Exactly. It's performative. You're documenting the past. Pinterest is fundamentally different because it is forward-looking. You don't go to Pinterest to show people what you did. You go there to plan what you intend to do.
That's a key distinction.
It is the whole ball game. You're saving a recipe for a meal you intend to cook next Tuesday.
Right.
You are pinning a sofa for a living room you intend to redecorate in the spring.
You're building a vision for your future self.
That's it.
So it's not look at me, it's help me.
Precisely. And from an advertiser's perspective, that distinction is worth its weight in gold.
How so?
In traditional social media, ads are interruption marketing. You are watching a funny video and suddenly an ad pops up. It's annoying.
It's so annoying. I skip those immediately. I pay extra for premium subscriptions just to avoid them.
Most people do. But on Pinterest, because you are in a planning mindset, you're actively looking for inspiration, the ads can actually be the answer to your search.
Ah, okay.
If you are searching for rustic living room ideas and you see an ad for a rustic coffee table, that's not an interruption.
That's a solution.
That's a solution. The friction is lower because the user is already in a hunting mode. They have essentially raised their hand and said, I am interested in buying something in this category.
And that gets to what the report calls the commercial intent moat.
Exactly. And that moat is built on 15 years of data. But it's not just data on what you bought, like Amazon has, or what you searched for, like Google
Oh,
has.
what kind of data is it?
It's associative data.
Associative data. Break that down for us.
They know how you style things. They know that if you like this specific mid-century modern lamp, you are statistically likely to also want this specific type of geometric rug. They understand aesthetic intelligence. That is a data set that is incredibly hard for a competitor to replicate overnight.
It's like they have mapped the DNA of taste.
That is a great way to put it. And as of 2026, this business is built on 3 pillars. First, you have discovery. That's the taste graph we just mentioned. The AI predicts what you want before you even know you want it.
Which is spooky, but useful.
Very useful. The second pillar is curation.
Right, the boards.
This is the retention mechanism. Think about the boards you build. If you spend 10 hours curating a dream home board, that is a sunk cost. You aren't going to just leave the platform and lose that digital library.
It's like moving houses. You don't want to pack up all your stuff, so you just stay.
Exactly. It creates stickiness. And the third pillar, which is the most important for our valuation today, is action.
Okay.
This is the pivot that has happened over the last 3 years. Pinterest has moved from a place where you just look at things to a place where you shop for things.
And we are seeing that with the deep links, right? The shoppable pins.
Yes. Mobile deep links and direct links. It used to be that you'd see a cool pair of shoes on Pinterest, click it, and end up on some broken blog page from 2012. It was a dead end.
Oh, that was so frustrating.
Extremely. Now you click it, and it takes you straight to the checkout page on the retailer's app. They have reduced the friction between wanting and buying.
They've greased the slide.
You got it.
I want to touch on one other thing mentioned in this chapter, brand safety. The internet in 2025, 2026 feels, well, let's be honest, is a bit of a dumpster fire.
It is toxic. Between the political polarization, the misinformation, the comment sections on news sites, it is a minefield for advertisers.
Absolutely.
If you are a brand like Disney or Coca-Cola, do you really want your ad appearing next to a heated political argument or some conspiracy theory?
Definitely not. You want to protect the brand image.
And Pinterest calls itself an oasis. It is inherently non-political. You don't go to Pinterest to argue about the election.
Yeah.
You go there to look at garden gnomes or bathroom tiles.
It's a safe space for commerce.
That safety is becoming a premium asset. Advertisers are fleeing toxic environments, and Pinterest is the safe harbor.
And before we move on, we have to bust one myth, the aging out myth. I feel like there's a perception that Pinterest is just for, older millennials planning weddings.
Or moms planning baby showers, right?
Yeah, exactly.
The data completely contradicts that. As of late 2025, Gen Z makes up over 50% of the user base.
Over 50%.
Over 50%. They use it for vibes. They use it for creative inspiration. They are making collages, which Pinterest actually built a specific tool for. The platform isn't dying with its original demographic. It is regenerating.
So we have a clear utility, a data moat, and a growing young user base. But a great car needs a great driver.
Management evaluation.
This brings us to the Buffett rule. Evaluate the management. You bet on the jockey, not just the horse. And Pinterest has had a major changing of the guard that defines its current trajectory.
It really has. We moved from the era of Ben Silbermann to the era of Bill Reddy, and this distinction is crucial for investors to understand.
Silbermann was the founder, right? The visionary.
Yes. Ben Silbermann was the product architect. He built the beautiful pinning mechanism. He created the digital scrapbooking culture. But, and this is a common story in tech, he wasn't necessarily the guy to monetize it ruthlessly. Under his tenure, Pinterest was beautiful, but it was slow to build ad tech. It was a walled garden.
He didn't want to ruin the aesthetic with too many ads.
Exactly. And then comes Bill Reddy in 2022.
Right. And look at his resume. Google Commerce. PayPal COO.
His DNA is transactional. He isn't thinking about likes or repins. He's thinking about gross merchandise value and conversion rates.
He's the operator.
He is the operator. And he has executed a textbook turnaround. The most significant move, and it was a humble one, was opening that walled garden.
Humble how?
He admitted, look, we have all these users, but we don't have enough advertisers to fill the slots. We are leaving money on the table.
So what did he do?
He signed deals with Amazon and Google.
Which seemed risky at the time, didn't it? Letting the big dogs in.
It did. People thought he was giving away the farm. But it was brilliant. It instantly filled their ad inventory. If Pinterest couldn't sell an ad slot, Amazon would fill it automatically.
It monetized the user base immediately.
Immediately. It showed that Reddy prioritizes revenue over ego.
And now they are doubling down on AI with this Pinterest Performance Plus Suite.
This is their answer to Meta's Advantage Plus and Google's Performance Max. Basically, it uses AI to automate ad campaigns for brands.
So the brand just gives it a budget and some photos.
Pretty much, a budget and some creative assets, and the AI handles the targeting and bidding.
And does it work?
The results are staggering, a 24% higher conversion lift in early testing. In this economy, retailers need performance. They don't want brand awareness. They want sales.
And Ready is giving them a tool that delivers sales.
Precisely.
Let's talk about how they're spending their money. Capital allocation is the litmus test for management, right?
It is the ultimate test. Are they lighting money on fire, or are they returning it to shareholders? And here, the signal is very strong.
The share buybacks.
Through late 2025, management bought back nearly 9.8 million shares. And they were buying when the stock was down.
That's the key part.
It is. They are eating their own cooking. Buying back stock at 52-week lows signals massive confidence. It tells the market, we think our stock is too cheap, so we are going to buy it ourselves.
And it increases the ownership stake for every remaining shareholder.
Without us having to spend a dime.
But they aren't just hoarding cash or buying stock. They made a pretty interesting acquisition recently, TD Scientific.
Yes. This happened in December 2025. It's a deal estimated around $300 to $350 million.
What is TD Scientific?
It's a connected TV ad platform. Now, you might ask, what does Pinterest have to do with TV?
That was my first question. They seem like opposite ends of the spectrum.
It's about the omni-channel journey. Imagine you are sitting on your couch watching a streaming service, and you see an ad for a new line of furniture.
Okay.
You don't buy it on your TV remote. That interface is terrible. But 20 minutes later, you pick up your phone and open Pinterest.
Ah, I see where this is going.
This acquisition allows Pinterest to connect those dots. They can track that the person who saw the TV ad is the same person searching on mobile.
So they are linking the living room to the phone. It solves the attribution problem.
Exactly. And from a risk perspective, I love this deal. They have nearly $3 billion in cash. Spending $300 million is a bolt-on.
Just a small piece.
It's 10% of their cash pile. It's not a bet-the-company acquisition that could sink them if it goes wrong. It's smart, strategic, and affordable.
So management checks out. They are rational. They are focused on sales, and they are disciplined with cash. But let's look at the scorecard.
Financial health.
We have talked numbers. Because the narrative sounds great, but does the math work?
The math is surprisingly robust, especially given the macro headwinds we are facing.
Let's start with the revenue. What are we seeing there?
In 2024, revenue grew 19%. And throughout 2025, despite the tariffs and the economic anxiety, revenue has been consistently growing at 16 to 17% quarter over quarter.
That is double-digit growth in a tough environment.
It is. It implies that the Amazon and Google partnerships are working. They are counteracting the macro headwinds.
Now, here's where it gets tricky. If you look at the 2024 headline net income, it says $1.86 billion. That sounds incredible.
It sounds too good to be true, and it is. This is a trap for the lazy investor.
Okay, what's the catch?
That $1.86 billion includes a one-time non-cash tax benefit of about $1.6 billion.
A tax benefit.
It's a release of a valuation allowance. It's accounting noise. It's not real cash coming in the door from selling ads.
So we should just ignore that number.
You have to strip that out. The real number to look at is adjusted EBITDA and the trend in GAAP net income.
And what do those tell us?
Adjusted EBITDA margins are sitting around 29%. That is elite software-level profitability. And if you look at Q3 2025 GAAP net income, the real number, it was $92 million, up 201% year over year.
201% up.
Yes. That shows that the business is scaling. Costs are growing slower than revenue. That is operating leverage. As they get bigger, they get more profitable.
And finally, the balance sheet. We mentioned the cash earlier.
It is a fortress. They have about $2.7 billion in cash and equivalents.
And debt.
Their debt is negligible, around $137 million. So they have net cash of like $2.5 billion.
Right. In a world where interest rates are volatile and tariffs are squeezing credit markets, Pinterest doesn't need to beg bankers for money.
They can self-fund. That is a massive safety net. It means they control their own destiny.
Which is exactly what you want when the economy feels shaky.
Absolutely. Cash gives you options. It gives you the ability to play offense when everyone else is playing defense.
All right, we are going to take a quick breather. When we come back, we are going to look at why, if everything is so great, the stock is so cheap. We'll dive into the market sentiment, who actually owns this thing, and the big risk, those 2025 tariffs.
But first, a word about where all this data is coming from.
Like and subscribe to StockAnalytics.AI.
Want institutional-grade stock research without the institutional price tag? Check out StockAnalytics.AI. For just $10 a month, you get full access to our deep dive video library covering over 500 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify.
Can't find the stock you're looking for? Request analysis on ANY ticker, and we'll deliver it within 24 hours.
Upgrade to Pro for $20 a month and unlock our SEC Whisk Scanner, which detects red flags in company filings before they hit the headlines, plus our Portfolio Diversification Analyzer to optimize your holdings.
Start your 7-day free trial today at StockAnalytics.AI. Make smarter investment decisions with research you can trust.
Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion.
Market sentiment.
Welcome back. We have established that the business is solid, management is capable, and the financials are strong. So the elephant in the room. Why is the stock stuck at $25? Why is the chart so ugly?
It is the wall of worry.
The wall of worry. Explain that.
The stock market is a voting machine in the short term, and right now investors are voting on fear.
Fear of what?
They are terrified of the retail recession. They see the tariffs, they see retailers struggling, and they assume Pinterest, which relies on retail ads, is going to get crushed.
So it's guilt by association.
Essentially, the algorithm goes, retail is bad, Pinterest needs stock. Retail, Pinterest is bad. It's a very simple knee-jerk reaction.
But is it accurate?
Well, look at the analysts. We have 36 professional analysts covering the stock, 26 of them rated a buy.
That's a pretty strong consensus.
It is. And their average price target is around $37.11.
Wait, $37.11? That is almost exactly the intrinsic value number we teased at the beginning.
Exactly. The analysts who study the spreadsheets, who talk to Bill Reddy, who crunch the numbers, they know the business is worth more.
But the market sentiment is dragging it down.
The crowd psychology, yeah. It creates this divergence. You have business metrics revenue, users hitting all-time highs, and you have the stock price trading near lows.
That's the value gap.
That is the gap we hunt for. It resolves one of two ways. Either the business crashes to meet the stock price, or the stock rises to meet the business.
And given the fortress balance sheet we just discussed?
The crash scenario seems unlikely.
So we are looking at a coiled spring.
That's the hope. When the sentiment shifts, even a little bit, that gap can close very quickly.
Ownership structure.
Let's look at who is actually holding the bag here. Who owns the shop?
This is important because it tells us about the stability of the capital base. We aren't seeing a bunch of meme stock traders flipping this. The big holders are the adults in the room.
Who are we talking about?
Vanguard holds about 60 million shares. BlackRock holds about 38 million.
The big index funds.
These are long-term, passive giants. They provide a floor for the stock price. They aren't going to panic sell because of one bad headline.
But there is another player on the board who is a bit more active.
Ah, yes. Elliott Management.
The activist investors.
They own about 28 million shares. And crucially, they have a man on the inside. Mark Steinberg from Elliott is sitting on the Pinterest board of directors.
What does that tell you?
Elliott is what I call an insurance policy for the retail investor. They are aggressive. Their job is to unlock value.
So they keep management honest.
If management starts slacking off, or if the stock price languishes for too long, Elliott isn't going to sit quietly. They will push for more buybacks, they will push for cost cuts, or they will push for a sale of the company.
So having them involved basically puts a fire under management.
It guarantees that shareholder value is the priority. And the key is they haven't sold their stake, which implies they still see significantly more value to be unlocked.
They're betting on the upside, too.
They are.
Now, I have seen some headlines about insider selling. Malik Ducard, Ben Silberman, they have sold some shares. Should we be worried about that? It always looks bad when the founder sells.
I wouldn't lose sleep over it. You have to look at how they are selling. Most of these are what we call 10b5-1 plans.
That sounds like a robot name.
It basically means scheduled selling. These executives set up a plan months in advance to sell a specific amount of stock on a specific date.
For tax reasons or diversification.
Exactly. It happens automatically. It's not panic dumping based on inside information. It's just routine housekeeping.
Okay, so the selling isn't a red flag. But we do need to talk about the red flags that are out there.
Risk assessment.
We can't do a deep dive without looking at the dangers. And right now, the biggest danger is emblazoned on every newspaper headline: the tariffs of 2025.
This is the #1 risk. It is the reason the stock is down. We cannot sugarcoat this.
Let's break it down for the listener. How does a tariff on steel or Chinese goods hurt Pinterest?
It's a chain reaction. The U.S. administration imposed a 10–20% baseline tariff with much higher duties on Chinese goods.
Oh, okay.
Think about Pinterest advertisers. Wayfair, Target, home decor brands, they import a lot of stuff.
Right. Their inventory comes from overseas.
So suddenly their cost of goods sold their KGS goes up. A sofa that cost them $100 to import now costs $120. Their margins get squeezed.
And when a retailer's margins get squeezed, what is the first thing they cut?
The marketing budget.
Yeah.
It's the easiest variable cost to slash. You can't fire people instantly, you can't break your lease instantly, but you can turn off your ad spend in 5 seconds.
And we have hard numbers on that potential impact.
Forecasts suggest social ad spend could drop by $10 billion in 2025 because of this.
Wow. And since Pinterest is 78% reliant on U.S. revenue, they're right in the blast zone.
They are heavily exposed. There's no denying that. If Target stops spending, Pinterest feels it.
But,
Yeah.
and there is always a but.
Yeah.
You mentioned a shield earlier, the counter thesis.
The counter thesis is performance over branding.
Mhm.
In a recession or a tariff squeeze, retailers don't stop advertising entirely. If they stop advertising, they die. They just change what they advertise.
How so?
They cut the fluffy brand awareness TV commercials. They cut the billboards that just make you feel good.
Expensive stuff.
But they keep the ads that drive direct sales. They need the cash flow to pay for those more expensive goods.
Because they need to move inventory.
Exactly. And because Pinterest has pivoted to shoppability and these performance tools we discussed where they can prove you spent $1, you made $4, they are positioning themselves as a necessity, not a luxury.
They are selling sales, not just views.
That's the key.
So the argument is that even if the total pie shrinks, Pinterest might keep its slice because it's the most nutritious slice.
Or even grow its slice by stealing budget from less effective channels like linear TV.
Let's do a quick SWOT recap before we wrap this up. Strengths.
High intent data, unmatched.
Weaknesses.
U.S. reliance. They are too dependent on the American consumer.
Threats.
Meta and Google, they are the giants, and they are fighting for the same dollars.
But the opportunity.
Shoppable content. Closing the loop. If they can truly become the place where you buy everything you plan, the upside is massive.
Conclusion.
So what does this all mean? We have looked at the business, the management, the numbers, and the risks. Let's bring it back to Warren Buffett.
Buffett has a great quote from 1974. He said, "I feel like an oversexed guy in a harem. This is the time to start investing."
Classic Buffett. A bit colorful.
A bit, yeah. But the context was that the market was beaten down by inflation and oil shocks. Everyone was fearful, but he saw opportunity. And that is the vibe here.
So let's summarize the synthesis. What's the final story?
The business has a durable moat based on intent. The management is executing a rational turnaround, and the financials show a cash machine with a fortress balance sheet.
And the valuation, let's hit them with the final numbers.
We ran a discounted cash flow analysis. We were conservative. We assumed growth slows to 12% because of the tariffs.
A reasonable assumption.
And we used a standard discount rate.
And the number.
The fair value comes out to approximately $37 per share.
And the stock is trading at $25.91.
That is a margin of safety of about 30%.
You are buying $1 for 70 cents.
Plain and simple, it is a compelling discount. For the patient investor, the macro clouds, the tariffs, the fear are creating a mispricing. The engine under the hood is purring, even if the road is bumpy right now.
So to the member who requested this deep dive, you found a hidden gem. It might be a volatile ride through 2026, but the fundamentals are screaming value.
Absolutely. It's a classic dislocation.
Here is a provocative final thought for you to chew on. We talked about that TV scientific acquisition.
Mm-hmm.
If Pinterest effectively bridges the gap between seeing a TV ad in your living room and buying the product on your mobile phone, are they actually building the first true operating system for shopping?
That is a massive concept, an OS for commerce.
Something to think about while you browse your dream home this weekend.
Indeed.
Before we go, if you want to be able to spot these kinds of opportunities yourself, you need the right tools.
Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they hit the headlines, plus our Portfolio Diversification Analyzer to optimize your holdings. Start your 7-day free trial today at StockAnalytics.AI. Make smarter investment decisions with research you can trust.
Just a reminder that this content is for informational purposes only and should not be taken as financial advice. Do your own research.
Always.
Thanks for diving deep with us. We'll see you next time.